Today we're talking about managing risk as part of your financial plan, perhaps the most important part, because getting into the sexy stuff and the fun stuff afterwards is a lot easier once you know you are protected. So I went down my list. Death, that's pretty easy to take care of. You buy a life insurance policy. Disability, you can do the same. Now keep in mind, you got to qualify for all of these, so you better buy it before you get sick or disabled or uninsurable. Loss of job, that's where an emergency fund plays a key role. And I'm going to have Gene Pastula address that in a moment. But we left Gene with divorce. And then there's illness, long-term care, and I'm sure there's a whole bunch of others, but those are the only ones that could come to me during 2 breaks ago when I wrote them down. But divorce, that is a toughie, because no one can predict that. I guess the way you mitigate that risk is don't cheat and be financially responsible, because the two of those things are the things that break up the most marriages. Isn't that true?
Well, and try to be a nice person. I mean, you've got a partnership there, and one should realize, to be empathetic to the other individual as often as possible and expect.
How long you been married?
40 some odd years.
Okay, see, me too. So, and we've learned how to say yes, dear. I get all that, but let's go back to this emergency fund then, because if you have enough money stashed away for the inevitable, whatever that may be, one of these shocks that we talked about that's going to happen 4 times over the course of your lifetime, from age 20-something to age 70. Having a boatload of cash somewhere is probably not a bad idea.
Now, really, that whole category of not only emergency funds but investment in portfolio and all the like, that should be the number one priority financially when you lay it all out. And by that I mean you need to do it. It needs to be there. It needs to be growing, because at some point in time it's going to support your lifestyle, or a substantial portion of it if you're lucky. Now, I'm not saying that you eat cat food so that you can put more money in the bank, but the point is that by finding a way where you can literally take 5-10% off the top before you start planning your budgets and your lifestyle, that goes aside for those emergencies or the future. I got to tell you, based on what I see all the time, the future is going to be a lot brighter as a result of doing that, and the emergencies will be, at least from a financial standpoint, a lot greater. They're mitigated a lot better because of having those emergency funds and the ability to take care of them financially. Without, literally, if you can't do that, it just doubles down on the misery that any of these things.
Now you talk about this linked benefits plan. Mm-hmm. That seems to me to be a very efficient way to set up an emergency fund, because you kind of get a double dip on your dollars.
In fact, there. I've used it. That's been my bank account, if you will, my long-term emergency bank account for 30 years. Because the cash portion of those insurance contracts is just like, it's like the best savings account there is. They have ways of getting better interest rates. They're secure. The money is accessible, and then the insurance element that comes along that adds to it. So if you die, all that money in that account plus an element of insurance goes to your beneficiary and provides an element of insurance. That solves addresses a couple of problems right there. Add a little bit of term insurance to it. It's really, really cheap while the kids are in place, and you've addressed very responsibly 2 of the major issues.
Well, let's talk about the third one, though, because if it's loss of job, because that one usually comes to the forefront of everybody's mind, because if I lose my job, I don't have an income, I may need an infusion of capital for 2, 3, 4, 5 months while I'm trying to seek out another job. If you had one of these plans and you put, say, 100 grand into it, or over time you accumulated 50 or $100,000, you said the money is accessible. Can you explain how accessible that is and what you mean by accessible?
Yeah, call the insurance company and say, I want to withdraw some money from, or your representative or whatever, I want to withdraw some money from that cash account. They'll discuss with you, do you want to actually withdraw it, or would you prefer to borrow against it, and we'll give you the same amount of money, but we'll set it up as a loan against that.
So you can pay it back.
So yeah, so what's your intention? Are you just going to take it out and never give it back, or are you going to replace it? Well, then we'll set it up as a loan, because, and without getting into the weeds on it, it's a better way of doing it. Point is that, each year you get a statement that tells you how much money is available to you for whatever purpose.
Okay, real quick. Big loads, I mean, you hear about big loads, you're not going to have all your money, you're going to pay 10, 20% off the top in commissions. Talk about that.
Yeah, well, nothing is free, but depending on how you design the contract, obviously the basic costs of doing it are up front in the first year typically, and then after that there's maybe a 1.25% charge against the deposits put in or whatever, and it varies all over the place, and you should be cognizant of that. But it's not unlike paying commissions to a stockbroker or fees to a financial planner. I mean, nobody does this for free, but in return for any costs that are there, and you certainly can control what they are by doing your due diligence. There's a lot of benefits available. I mean, when you look at setting up a bank account that you want to accumulate $100,000 in by the time you retire or whatever, versus an insurance contract for $100,000 of death benefit, I mean, that's self-completing. You die 5 or 8, 10 years down the line, and whatever you've got in that bank account is it. In the insurance contract, you have $100,000 just like that. So, I mean, and there's a variety of other benefits in there to cover long-term care and disability and all the rest of the stuff. So there are charges that will be in place against the money that you've accumulated and the interest that is there. But when you look at what does constitute the risk management issues that they address, it's dirt cheap.
Now, someone told me, I think it was Tim or somebody at your office, that the principal is protected. Is that correct?
When with whatever it was you were talking about, probably that was what he was addressing. Each of these different insurance contracts that we have available, have their own specific financial designs and what have you. For example, the one that I've talked about a lot on this show is when we move money from a bank account into an insurance contract that is designed specifically for the purpose of covering long-term care risk. And we do it by using a life insurance policy as opposed to a traditional long-term care policy, because we know that setting the life insurance policy up, somebody's going to get a benefit someday. And so whatever money we put in there is going to come back plus a return, either to us for care or to our beneficiaries. When we do that, and we do put large lump sums in, one of the things that we make sure the policy does is provide access back. All that money we put in, or the vast majority of it, is available back at any time. So it's not like you're spending the money, you're just redepositing it in the insurance policy as opposed to the bank. And while it's there, it earns typically higher interest, and that interest, some of it, is used to buy additional benefits, which is why you chose this in the first place. So each one of these things has its cost structures and its purpose, and when you match those against the risk management that you're trying to accomplish, the interesting thing is, of all the solutions you could have, these are the ones that are most predictable, and they will work and take that stress right off the table.
So what we've learned today, obviously from Mr. Pastula, and thank you very much, Gene, for that, is there are ways for individuals to take on their personal responsibility when it comes to managing risk. Instead of blaming it on somebody else, blaming it on the government, blaming it on 401k plans, blaming it on somebody. And that seems to be what we do today. It's always somebody else's fault. Why don't we look inside first and take personal responsibility for managing the risks in our own retirement and financial plan? Death, disability, loss of job, divorce, illness, long-term care. Many of those risks can be managed, and all of them when you call Gene Pastula.